And good morning, everyone. Welcome, and thank you for joining us today for our Winter Tax Forum. I'm Anna Darwenda. I'm a partner in our tax section in Richmond, and I focus my practice on transactional issues for both domestic and international companies. I'm joined today by my colleague, Nona Massengill, who is a partner in our employee benefits and compensation section. Nona is our go-to resource for everything compensation, especially issues related to 409A, stock options, and ESOPs. And Nona is also based out of Richmond. So before we begin our program, I have a few housekeeping items. At any point during the presentation, you may submit questions by using the Q&A button at the bottom of your screen. We will address questions as time permits. We do usually talk a lot, so keep that in mind. So if we don't get to your particular question during the webinar, we will follow up with you. Also, if you are having any audio or technical problems, please use that same Q&A button and we will help to resolve those issues. This program has been approved for 1 credit hour of CPE credit, and our application for 1 hour of CFP credit is pending. This afternoon, you'll receive an email with the certificate of attendance for CPE, and we'll send a separate email when our CFP credit has been approved. And in order to qualify for those credits, you must participate in polling questions. So I'll repeat that because it's important. So in order to qualify for credits, you must participate in polling questions. Don't worry, they're going to be fun. But please note that if you are using multiple monitors and don't see the poll window, make sure to check all of your monitors, as the poll may appear on a different monitor than the one where your Zoom window is showing up. So we have pulled up a test poll, so hopefully everyone can see that. And the questions are, why are you attending today's program? So option A is that you love Williams Mullen and you desperately need CPE or CFP credit. And option B is that you love Williams Mullen and couldn't resist spending your Thursday morning with us with or without CFP credit. So we'll just gotten quite a few responses. So we'll just give everybody a couple seconds to make sure that everybody sees that poll and has a chance to respond. Okay, so I think we have everybody's responses, and I'm heartened to see that that everybody just wants to spend some time with Williams Mullen. So I definitely appreciate that. And now that we know where we all stand, I will hand it over to Nona to talk us through the tax issues impacting equity compensation. And Nona, the floor is yours.
All right, thank you, Anna. So as Anna noted, I'm going to speak today about tax issues relating to equity compensation that I see frequently. And we are actually going to do an official poll question before I begin my remarks. So yeah, here we go. So this is a question I'm very much interested in your thoughts on. What types of equity awards do you see offered frequently? Phantom equity, stock options, profits interests, restricted stock, or all of the above? And we're going to give it a little time. And we'll be talking about all of these types of awards as we go through today. All right, it looks like most responses are in, and the winner is stock options. And I find that interesting and something that aligns with a trend that I'm seeing. Earlier in my career, stock options were just, you know, I frequently always worked with them. Went out of favor perhaps a little bit over the years, but I am really, in the past couple of years, it's frequently offered by clients that I work with. So that makes sense. All right, well, I think we're ready to begin. So next slide, please. All right, so we're going to kind of categorize the remarks today by code section rather than by type of award, and just confirm what you may already be familiar with, may not, some of the basics on whether a particular code section is implicated when you see a company or a client faced with questions regarding a particular type of award. So Section 83 of the code, very important. And the heart of this code section is that it governs tax consequences of property transferred in connection with the performance of services. So two key elements there. One is that the property is transferred in connection with the performance of services. So sometimes you'll see a situation, and I deal with this frequently actually, where the property transfer may be actually proceeds, it may be consideration in a transaction. It may not necessarily be considered for services or in connection with the performance of services. So that's a key part of an analysis as to whether Section 83 applies. It's also only relevant if there is a property transfer. What this means, and I get this question a lot with regard to Section 83B elections. Should I make an election? Should we be talking about whether an election is appropriate? It's only relevant within essentially the 30 days following the date of property transfer. When an option is granted, that is not considered a property transfer for purposes of Section 83. So that's one time at which that's not a consideration. Another type, and kind of doing the exclusions first, but just to, sort of, it's always nice when you can check something off the list, cross it off the list. Not profits interest, phantom interest, any type of phantom equity, restricted stock units, that type of thing. If it is a promise to deliver property in the future on satisfaction of particular events, that's not an instance where an 83B election is would be in the mix. So the 83B election, which I'm sure many of you are familiar with, but let's discuss, that is an election by the recipient of the property, so the employee generally, to take, to sort of lock in the compensatory element, to take the full value of the property into account for tax purposes as of the date of grant at the value on the date of grant. And, that is certainly a very useful technique for an early stage company anywhere in a situation where there's the anticipation is that there's going to be a lot of growth in the stock. It also can be relevant. We'll talk about this on the next slide, I believe, but where there's been full payment for the property, because you take into account income under the 83B election at the value on the date of grant, less the price paid. So if you paid full price for the property, but the property for whatever reason is still subject to vesting that otherwise would defer taxation, it's kind of a no-brainer to go ahead and make the election because there's no income recognition since full price has been paid. 83B election should be considered, not saying should be made, but should be considered, and considered ideally in advance of the transfer, in advance of the grant date, for restricted stock, restricted partnership interests, for profits interests, even though those generally would not result in any compensatory feature. I still regularly, and we recommend protective 83B election for profits and trusts in virtually all cases. Vested equity that is subject to sort of punitive buyback provisions. That is something you may be familiar with, or it's quite common, but it is maybe less apparent that for Section 83 purposes, a grant of equity, and this often happens with rollover equity in a transaction, or I would say that's the most common situation, but sometimes even even with outright grants of equity, where the agreement itself states that the equity is vested, but that the equity is subject to the terms of an LLC agreement, for example, or a shareholders agreement. You look at the provisions of that agreement, and there are vesting provisions that would prevent, say, on a termination of employment, an individual from, the company might have a right to buy back the interest at less than the fair market value on the date of buyback. So that, again, it might not be phrased as vesting in the organization documents, but if it in substance is a vesting and it's tied to company performance objectives or duration of employment, then it should be viewed as potentially delaying income taxation on the award absent an 83B election. So that, that's a lot to pack in for one little bullet point on my slide, but it's an important thing that we really do see often. And then another less common situation where an 83B should be considered, and it's less common, but Anna and I have discussed it, in the past month, I would say, is the exercise of an option for equity that in turn is unvested. It does happen, and that might be a time, not grant of the option, but exercise the option. Then you get property that, could be appropriate for an election. Okay, so as I've mentioned before, certain types of awards are not considered a property transfer and at receipt. And I guess this is sort of blending 2 points, this last bullet point. I do want to mention, because this is also a type of award that I see very frequently in the past 18 months, has been, any variation on phantom equity. And I guess just keep in mind that phantom equity can come in many different flavors and have many different names: phantom units, P units, RSUs, phantom stock. Sometimes even transaction bonus agreements that are settlable in stock really have the same effect as an RSU. So I think there it's just a matter of really honing in on what the substance of the award is. All right, next slide, please. Yeah, so we'll talk a little bit now more in depth about these revesting or rollover transactions and how those are implicated in the context of Section 83. So it is something that is often required by a buyer, that where there would otherwise be simply, equity for equity in a transaction, that a portion of the received new equity be subject to additional conditions. There are a lot of ways to analyze that, I think, and it is I think logically it would be an open question as to whether that really is transferred, in consideration of what's being given up or for services. But there is authority for different permutations of that situation. And we often look to Revenue Ruling 2007-49, and it really drills down on the mechanics of what's happening in a particular situation. Is someone receiving new equity? Are vesting conditions being placed on existing equity that has not been given up or transferred? That could produce a different result. Is the transaction at issue a tax-free reorganization? That seems not to matter, I believe. I believe I recall, but the revenue ruling makes it clear. But that doesn't, I guess what I would say, prohibit an individual from making a Section 83 B election that will be to their advantage, even though at the time of closing, there's no income recognition or even gain recognition. So that's an interesting point that makes sense, but that is discussed more thoroughly in the revenue ruling. I also am going to switch gears a little bit now from the 83B election to treatment of options in a transaction. Non-qualified stock options, meaning non-ISOs, are governed by Section 83 because the exercise of the option is deemed to be a transfer of property. And so there are different consequences in a transaction that stem from how options are handled. Are they cashed out? Are they exercised for unvested equity? We mentioned that before. Are they cashed out for unvested equity, meaning simply canceled, a new equity is transferred or conveyed? Each of those can have a little bit of a different consequence under Section 83, also for withholding purposes. I don't think we have time to, I do have a withholding slide a little later on. Don't have time to go into too much detail on that right now, but just be aware that how options are handled can have slight variations on the tax treatment, none of which is, a terrible consequence or anything, but just need to be consistently followed through with both the income recognition reporting and withholding. Okay, so I think now we have another poll question. Yeah, okay, so the question here is, do you see equity incentives offered on, sort of regular ongoing basis, or, simply tied to an exit event? And please just choose one. Okay, so we're getting a lot of responses here, which is great. And it looks like it's fairly close among participants, perhaps a little higher on the regular basis, ongoing, annual type of schedule. That has come out with a slight edge, more than simply tied to an exit event or equal prevalence. But I think that's interesting. I would say what I see is probably about equal prevalence. Certain larger or public companies certainly are going to have LTIP programs built in, and the mix of awards can change from year to year, and maybe not from year to year, but say every few years, depending on really what the market expects and what investors expect. In closely held companies, certainly an exit event may be a very important component of equity, but anyway, that's great, and thank you for your response there. So I think we can go to the next slide. All right. So Section 409A is a big aspect of equity compensation that has to be considered. Fortunately, there are certain awards that are not implicated by 409A. And that may be on my next slide, but I think it's sort of important to put that up front, is that in general, actual transfers of equity, those types of awards that might be eligible for an 83B election or governed by Section 83 primarily, are not subject to any or as many of the rules under Section 409A. So mainly restricted stock, restricted capital units, profits, and trusts generally do not have to deal with the rules, parameters, payment restrictions that can be so cumbersome under Section 409A. That's great. Incentive stock options are excluded from Section 409A. However, if to be an incentive stock option, there's a separate scheme that has to be followed, and generally those options have to be granted at fair market value, very similar to the case for non-qualified options. But anyway, I think the main good news is profits, interest, capital interest, restricted stock, you're generally not having to jump through the 409A hoops. So one of the biggest effects of Section 409A on equity compensation over the years, and this is not new, is that options have to be granted at a fair market value exercise price. One, I would say, twist on that, or something to keep in mind, is that appreciation rights also fall into that same category. So an award that is not called a stock option may not even be called a stock appreciation right, or SAR. It may be called something else, appreciation unit, come up with a name. But if it's an award other than a full value award, then you have to look at whether it has a base price or an exercise price that has that is fair market value as of the date of grant, and follows an appropriate process for setting fair market value. Now, it's very straightforward to set that price when you've got an exchange traded stock. Thinly traded securities, and I've seen this recently, are generally considered readily tradable, which is, it can be a little tricky, because if there aren't frequent trades, but 409A requires use of actual trades in the market to set the price, you have to look at the regulations to find a permitted method of setting value, setting base price that makes sense for the organization. For closely held companies, companies that clearly are not readily tradable on an established securities market, there's going to be, this is just a big deal. And companies who have been offering options for a while, or are working with their accountants or counsel, they recognize often the value of getting a third party valuation. And even though it might initially to a client seem unnecessary or costly, really aren't that costly any longer. But it just makes life so much easier. And really, in the context, this is when people are hit up in a transaction or a significant investment, depending on accountants or counsel on the other side. All the bells and whistles, are going to be scrutinized, and not only whether there has been a third-party valuation, but whether it's been done at least annually, whether it's been updated for intervening material events in between, sort of the annual cycle. So it's just really important for companies to realize that it is to their advantage to figure out what is required for their organization under 409A in setting exercise price, and just do it. There really isn't any other way around it. If there are clearly non-safe harbor methods for setting exercise price, and we help clients work through that all the time when for whatever reason they are not in a position to get a valuation, but it is easier to get one. What I've noted in the last bullet point on the slide is not it's not just limited to appreciation rights, but it is something that I've literally I've seen in the past week with an option plan. Is by design, the company sort of concedes that they are not going to be using they want to offer it below market based price or exercise price, or they specifically are not going to get a valuation, or for whatever reason they're just not using their option plan in that way. There's always the ability to comply with 409A, treat the award as deferred compensation from the get-go, not try to fit within the third-party valuation regime, and just simply say that the award pays out on 409A permitted events, where the award is going to be paid and everybody sort of anticipates that it's an exit-based incentive. That's pretty easy. The payment date could be a 409A change of control, which is pretty broad and would probably encompass most exits. Another, it can also be the earlier of an exit or separation from service, an exit or a fixed date. So that is an alternative that isn't too complicated. It's just not intuitive when you think about an option, which generally can be exercised at will. Next slide, please. Okay, and I know we're getting kind of close on time for me, so we're going to hit this pretty quickly. Again, happy to answer any questions offline if they come about. So transaction-based payouts can be achieved under Section 409A, both for full value awards and under proposed regulations for appreciation awards. The 2016 proposed regulations can be relied upon, and the regulations, and it's called transaction-based compensation in the regs, but they provide guidance on how to follow the same payout schedule that shareholders receive, follow the same conditions that they are subject to, and do this while still complying with 409A, even though the payout timing and amounts are going to be somewhat uncertain. Distribution equivalents are something to watch out for on phantom units. I typically advise structuring those as short-term deferrals, meaning basically distribution equivalents you get those only so long as you're employed. You lose the right as soon as you leave employment, even if you retain the right to an exit-based payout. Next slide, please, Anna, and then we'll hand it over. Some other code sections that are important in the context of equity awards: 3121V, this is the special timing rule for FICA taxation of deferred compensation. RSUs are the type of awards that are most likely to be, relegated to not relegated, it's really a benefit, but, fall under this special timing rule. Not in every case, but, something to look out for. Wage payments, always keep in mind that the vesting of restricted stock, the exercise of an unqualified option, this is wages. The wages are subject to reporting and they're subject to withholding. Withholding in closely held companies is always, there are ways to handle it, but that's something that someone should plan for, client should plan for when they're setting up their program. And then finally, 280G, parachute payments, accelerated vesting, post-closing awards, but promised prior to closing, all need to be considered for parachute calculations. And with that, I believe that I will turn it over to Anna, and thank you very much.
Thank you so much, Nona. That was a really great summary of issues that we deal with all the time. So thank you very much for that. Mm-hmm. So I'm going to talk about sort of two major topics that are completely unrelated, but it's items that we've been seeing a fair amount recently. And so we just wanted to make sure that folks were aware and just sort of how to have a discussion around them. So the first topic is section 118. And so I'm actually going to start with a poll here. And so the question is, do you have clients or has your company received any inducements or incentives from state or federal governments in the last 6 years? And so it's yes, no, or maybe. I'll just give folks a moment to respond. All right, so I think we're getting to about everybody's responses. And interestingly, we've gotten, it's sort of split between yes and no. So some of you have and some of you haven't, and some of you maybe have, which is fine. And I think it's, it's good if you haven't, and if you haven't, just so that you're aware of the rules, because it's definitely, I think the change in this section has become a little bit of a trap for the unwary. Especially as we've been seeing maybe the federal government provide some support, especially in COVID times, for spending on PP, on like personal protective gear and just things like that. So it's definitely something that we're seeing crop up. So sort of hopping right into the slides, maybe the first question is really, what is 118? And prior to the Tax Cuts and Jobs Act, 118 basically provided that contributions to a corporation are not taxable. And so this really included not just shareholders of a corporation, but also specifically included the value of land or other property that was contributed to a corporation by a governmental unit or civic group for purposes of inducing the company to locate its business, of enabling the company to expand its operating facilities. And there were some limitations on that. There was a corollary rule to this. So if you received property then you don't get basis in that property. So you effectively couldn't double dip. You couldn't get property tax free and then turn around and be depreciating that property. And if you received cash, any basis of property acquired with that money during the 12-month period afterwards was actually reduced by the amount of that contribution. So they were trying to make sure that people really didn't take advantage of that. And that rule was under 362. And there's also, I think, another corollary rule that basically provided that you could not get a deduction for expenses paid with the proceeds of that grant. And again, that sort of went to the zero basis theory. So this all sounded very well and good. And I think a lot of folks were relying on it really until the TCJA. And the TCJA basically turned around and it actually specifically in the statute added an exclusion for any contribution by any governmental entity or civic group. So that is excluded from the definition of a contribution to the capital. And so this applies to contributions that are made after December 22nd, 2017, the date of the enactment. But there is a limited exclusion from the exclusion of master development plans that were approved before the date of the enactment. And so there's sort of a question of, this provision, as I'll talk a little bit more about, 118, and the exclusion for basically governmental grants has been in place for quite some time. And so there was a question of, well, why did the government, decide to exclude it sort of, seemingly randomly? And there are some practitioners that have sort of theorized that, well, it's sort of curious timing. And it's sort of curious that it was late 2017 that Amazon announced that it was going to be building its second headquarters. And of course, at that point, there was, a flurry of states that were vying for the headquarters and, were ready to provide incentives for Amazon to do that. And so less than 1 month later, after that announcement, the IRS, as part of its LBNI compliance campaigns, included an economic development incentives campaign. And there was a concern, they noted around that there were certain government incentives that maybe, weren't being properly treated by taxpayers. And that campaign was followed by a report by the Ways and Means Committee that included, as part of its tax reform proposal report, that the committee believed that basically 118 should be removed because it applies first only to corporations. And it also believed that it provides corporations with a benefit that other entities don't get, which is really basically results in these corporations getting a federal subsidy because that income is excluded from taxable income. So they're basically getting a federal subsidy for the state and local incentives, which said it's fine for you to get state and local incentives, but the federal government shouldn't be footing that bill. And then promptly after that, we had the TCJA. So, it's sort of interesting timing as far as how all of that happened, but that, it may provide some insight, but I think, honestly, this section is one that maybe the government has been struggling with for some time, just as it's evolved. And so, I think to maybe add a little bit more context, I think it's important to sort of go back to maybe where these ideas came from, because now that we don't have a nice and neat exclusion in 118 for these government grants, are there other ways to exclude this income or, to characterize these types of transactions or, to set them up differently, or maybe even to look at different like judicial doctrines in the law that may help us out. So I think sort of understanding where maybe some history behind this is sort of helpful. Plus, I think it's kind of interesting because these cases are go back for quite some time. So it started. One of the seminal cases started with this Cuba Railroad case. It was a New Jersey company that owned and operated a railroad in Cuba that was partially funded by subsidiaries from the Cuban government. So the company had excluded the subsidies, but the US said, well, you got some sort of benefit, so it should be taxable. And it should be taxable, at that time under Revenue Act of 1916, which imposed an annual tax on total net income received from all sources. So the question was, are these subsidies income or are they something else? And the court basically provided that there wasn't really, under the contracts and under just sort of generally applicable law, that the subsidies, there was nothing that provided that the subsidies had to be used for dividend or interest or anything that typically comes out of earnings or income. And they decided that these subsidies were not payment for services rendered or to be rendered. So, based on this analysis, they weren't really profits. And so they really shouldn't constitute income. So we had a few of these cases. There was another one, Texas and Pacific. They came out a few years later. And this one was a little bit different because under this one, the federal government had given railroads a minimum operating income for 6 months after World War I, when the railroads had been nationalized. And after the war, when they reprivatized, they were aided via these federal payments. And so this was another Supreme Court case. And again, the court looked to the function of the funds, but here it found that they were actually distinguishable from the subsidies in Cuba Railroad, because here the function of this was to actually make up a deficiency in income. And so in this one, they were actually taxable income. And then we had a couple more cases. In Detroit Edison, in this one, the company had received payments from prospective customers to cover the cost of extending the facilities to those customers' homes. And so in this one, the court said, well, I mean, these are customers, they're payments from customers. It can't really, it's a little bit of a harder ask to say that, these are sort of donations or contributions to the company. How do you distinguish these from being just payments really in return for future services? And so in Detroit Edison, the court found that those payments had actually been for services rather than contributions to capital. But then in Brown Shoe, the payments were actually made to a corporation by community groups, really to induce the company to locate a factory in their community. And the court in that one decided that that was more for an inducement for creating an inducement for putting their factory in that location. And so it was different than payment for services. So up until this point, we had sort of a whole bunch of different cases that were really getting into the details and were really very fact specific. And so in 1954, Congress passed another version of the Internal Revenue Code, which was pretty comprehensive. And this was the first time that we saw Section 118 and its corollary 362, our basis corollary. And 118, similar to what it looked like before TCJA, provided this exclusion for contributions to the capital of a corporation, including by non-shareholders. And they also included 362, which assigned a zero basis to any contributed property. So interestingly, at this time, neither of those sections defined a contribution to capital. And you might wonder, well, why did 118 limit itself to corporations, to capital contributions received by corporations? And it really may be because LLCs really didn't exist at that time. So most companies were set up as corporations, and they just weren't as many choices as there are now. So it may just have been, just by virtue of what was available at that time. So we still had, we still have another case, this Chicago, Burlington, and Quincy Railroad case. So even though this was a 1973 case, it actually covered periods prior to the 1954 code that had introduced 118. So on this one, it was really a question around depreciation on constructed assets that the government had required the company to pay or to put in place, and they had also paid for. And so the court really had to go through, what is a contribution to capital that resulted in this denial of depreciation. And this is where we came up with this is sort of where the court came up with this 5-factor test. So it starts off with 2, is a contribution to capital, how do you determine whether it's a contribution to capital? So first you look at the intent or motive of the governmental unit, and then you look at the economic effect of the transferee corporation, so the recipient. And this is where we have our 5 factors. So first, is it a permanent part of the company's working capital? Is it compensation for specific quantifiable services? Is it bargained for? And does it foreseeably benefit the company in an amount commensurate with its value? And would it ordinarily be employed to generate additional income? So this 5-factor test, even though it was, it talked about, the case talked about periods before 1954. Once 118 came into play, this test is really what folks have looked at to determine whether you have a capital contribution to begin with that would then fit under 118. And really until TCJA, this has been sort of the framework. So anytime that you have, we had a company that was getting grants of land, bargain sales on land, infrastructure development grants, employee training grants, this is what we would look through, and maybe make sure that, we could prove that there had been some bargaining, and just that we fit into the rest of these, of these factors. And so these were the types of incentives that we were seeing. And so sort of flipping back to, well, so this was all well and good for corporate entities, but what about for non-corporate entities? And so interestingly enough, I think early on in the 70s, the IRS had basically said, well, basically said that they will apply 118 concepts to non-corporate entities. So if it's an LLC or partnership that is getting that contribution, then the principles of 118 should apply. And then it slowly reversed course on that. And in the 80s, and really continuing onwards, it really took, I think, a harder stance saying that, well, just statutorily, 118 doesn't apply to non-corporate entities, so that's what it says, and that's what we're sticking to. And there's been, I think, some, even like a recent court case on that as well, that basically said 118 doesn't apply to non-corporate entities. And so the question is really, where does this leave us now? So I think going through, if you either have had a company that maybe after TCJA received some incentives, and now you're sort of struggling to figure out what to do with them, I think there's, a couple things to look at. Like one is, well, pre-TCJA, the trade-off was it's not taxable income, but you don't get the basis. So now if it is taxable income, do you get the basis? And, would that at least solve some issues, or do you get the expenses? I think there's been some practitioners that have questioned, whether any, the conforming changes of TCJA to 362, the basis provision, have left some gaps. So there's, some questions there that hopefully, wouldn't be too controversial for IRS or Treasury to fix. But I guess that's just generally one question. Can you say, okay, well, we have the taxable income, but we get the basis. So is it a timing issue that, you can take advantage of? And if that's something that's not possible, taking a look at that transaction is, how would you now characterize it? Is it a loan? Is it a bargain sale? Is it something else that, okay, maybe you will have income, but is it something that could be deferred? Or, and if that isn't working, are there other judicial doctrines that could apply to limit the taxation? And I think that's a little bit trickier because it does seem like 118 in 1954, they did say that it was a codification of these types of principles. And especially since the government has been less keen on applying 118 to non-corporate entities, how much room is there, to try to say, well, some of those judicial doctrines should still apply. Or maybe there are other judicial doctrines. Can you look to, if maybe money has to be paid back, can you argue that the taxpayer really doesn't have dominion or control, or, so I think that's a little bit trickier because, when you're relying on case law and there's a whole lot of case law going every which way and it's very fact specific, as practitioners, it doesn't give us, as clear cut of an authority. So, I would expect that we may end up seeing some, maybe some new cases similar to those railroad cases cropping up on this if there aren't changes that are being made. And then I think for the, for the governmental entities that are providing these incentives, is there another way to provide the incentives that maybe avoids the issue? And so, could you be looking at to maybe a type of tax credit that would not provide taxable income? And I think that you have to look at because it really depends on if it's refundable or non-refundable or transferable, and the IRS has been looking at those. So, but it's just something to think about, if you're in a position where you might be looking to incentives going forward. So switching gears a little bit. Oh, and I forgot to mention, there is, now that these are taxable, that there is some compliance that the federal government has to complete. So switching gears a little bit, we wanted to talk about some tax accounting issues, and it's, I said cash to accrual, but it's really around deferred revenue. And so I guess maybe I'll do a polling question, which is, I think if we can get the polling question up, which is really if you or your clients expect to sell a company in the next year. Yes, no, or maybe. Okay, so we are about even, which I think is pretty interesting, especially as we're hearing about some of the banks and how they've been seeing a drop in the amount of deal work, but maybe that's just compared to last year, which was sort of a crazy year. But so one thing that we've been seeing is this question of, well, what happens if you have a business that has deferred revenue? So in this sort of simple example here, we have a company that has, some $1 million of deferred revenue on the books. And we usually see this in, it's really prepaid income. So it may be something that we see for newspaper or magazine business or vendors in the insurance business. They may have prepaid insurance premiums, or really in any other business that enters into prepaid contracts with customers. So basically, for federal income tax purposes, if you're an accrual basis taxpayer, that income is generally recognized when all the events have occurred, which fix the right to receive that income, and the amount can be determined with reasonable accuracy. And ordinarily, that right is treated as fixed when the taxpayer either performs the services or is entitled to payment. And so, in this situation, the seller has booked this as a liability, so for future services that will need to be performed, but it got the cash on it. So now the question is, well, if this company sells this business, how will it treat this this deferred revenue? And it's actually, I feel like this comes up all the time, but it's actually not that clear in the rules. And so there have been two approaches to this that folks have come up with. One is the assumption approach, and the other one is the fragmentation approach. So in the assumption approach, you basically treat the deferred revenue as really, it's a liability. It should be treated in the same way as any other assumption of any other contingent liability. So what that means is that if the seller has sold those assets, we would expect if it's worth 2 million, maybe the net would be 1.2, because you're reducing it for the assumption of that liability. And so the amount realized to the seller is the 1.2 plus 800,000, which that gives them a $2 million amount realized. They've got their adjusted basis of 1 million, which is their cash basis. So they have net gain of 1 million. But they also have, so that's just on the sale of the assets, but that deferred revenue is triggered in the asset sale. So they've got this $1 million deferred revenue. But then the thought is that they should have an offsetting deduction. So if the amount of the deferred revenue, prepaid income, was $1 million, but they think it's going to take 800,000 to actually fulfill that liability, the seller would claim that they should get an offsetting deduction, so they only have this net income of 200,000. And the buyer will have sort of similar consequences to any other liability that it picks up, would have the 1.2 in the assets, and then it gets the $800,000 in basis as the services are performed. So at some point it ends up with 2 million in basis. So that's one approach. The other approach is the fragmentation approach. And this really comes from this case called Pierce. And the reason that we raise it is that we've actually seen this in purchase agreements where the buyer will specifically say they do not want to treat it like a Pierce payment. And so what does that really mean? It means that you're splitting the transaction into two separate transactions. You've got your asset sale, but you've also got this this Pierce payment, which basically means that the seller will pay the buyer to to perform those services. So what does that look like for the seller? The seller still has its similar consequences in terms of the sale of the assets, and the seller is still picking up $1 million because of the deferred revenue, and it's paying the buyer $800,000 to basically take on the responsibility for fulfilling those contracts. So the seller consequences look fairly similar. It's the buyer consequences that are quite different, because if you're treating this as two separate transactions, now you have the buyer picking up this $800,000. And although it may get basis in the assets a little bit faster because it can pick up that $800,000 immediately, it may just not be keen on picking up that at $800,000. So, and I know I've gone through this kind of quickly, but it's just something I think to be aware of in transactions, because this is sort of complicated enough. But then it gets more complicated if it's a sale of a partnership interest that has this embedded on the inside, if it's a 351 transaction. So, it's something that we work through, because it really depends on, well, what do you think the value of that deferred revenue is? What do you think the value of actually having to fulfill those obligations is? And I think that's oftentimes the most difficult, difficult thing to try to figure out. And so it's just something, one more thing to add to the list of, when you're going through the checklist of having a sale, what's on the books, what do you expect the tax consequences to be, and what does the purchase agreement say? Because it's something that, obviously you want to think about before the sale is over and you get to your tax return, and suddenly you have to, figure out how to treat all of this. So sometimes we may, it may be something that's included in the purchase agreement, or it may be something that we don't address, and it's just a position that a seller or a buyer may take. But other times we may see specific language, especially on the buyer side, because they are not keen on picking up this income immediately. And so we want to make sure that there's nothing, especially on the sell side, that would affect the seller's ability to take that deduction, to make sure that they are able to offset any ordinary income that would result that's resulting because of that deferred revenue. So I know I went through that very, very quickly, but if anybody has any more questions on that, we'd absolutely be happy to chat further. So I think we are already over time, and I think that will conclude our presentation today. If you guys have any questions, please do put them in the Q&A, and we will try to reach back out to you guys as we can. And then, as I previously said, please look for an email from Williams Mullen this afternoon with a link to the presentation slide, as well as continuing education information about CFP and CPE credits. And thank you again very much for joining us today, and Happy New Year.